So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too.
Renowned expert Jim Rickards dissects the intricacies of the bond market, focusing specifically on U.S. Treasuries. He demystifies the classifications of short-term treasuries, bills, medium-term notes, and long-term bonds, emphasizing the significance of U.S. Treasuries while excluding corporate bonds from the conversation. Rickards reveals a surprising trend. Currently, the highest yields are found in 6-month to 1-year Treasury bills, challenging the conventional yield curve. He delves into the relationship between interest rates and bond prices, emphasizing the importance of predicting interest rate movements for smart investment decisions. Amidst global economic slowdowns and geopolitical uncertainties, Rickards hints that interest rates might have peaked, which would impact all of our financial strategies in an ever-changing market landscape. Here's the rest of the clip. Also, make sure to hit the like button, subscribe, and drop your comments below.
Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all treasury securities. But so I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly if a company's going to underperform. We're going to go into a recession. We're going to have you're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. But so we're talking about U.S. Treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. And so two-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. You know, the only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. So again, 10-year note is riskier. From a market point of view, not risky from a credit point of view, good yield and a lot of capital gains potential. If you have a slightly lower risk appetite, but you want the same basic kind of trade, have a look at the 2-year note, 5% yield, guaranteed principal, and my view, rates are not going up. If rates come down, you'll have a little capital gain on that as well. So those are the sweet spots. If you're really conservative, buy the 6-month bill. You get 5.25%, close to it. And it matures in 6 months, and there's almost no credit risk or market risk at all. But it's important to know that the world economy is slowing down. Germany is in recession. Japan is very close to it. UK, very close to it. Canada, I'm hearing nothing but bad reports, housing market collapse, etc. China may not technically be in recession, but it's slowing rapidly. The thing with China, it's the second largest economy in the world. They've been growing at like 10%, 10% for over 20 years. Well, you compound something at 10% for 20 years, you're going to increase it by a factor of 10 or so over that time period. But not now. They're almost certainly below 5. They're going to print 5 because they make up the numbers if they have to. But when you strip out wasted investment, I mean, investment that, you build a massive train station with 128 escalators and marble walls, but nobody goes there and the tickets are $10. You can't pay for that. It doesn't produce any wealth. It just creates jobs. So the real estate sector is collapsing. That's been the biggest driver. People are not stepping out to buy houses. They're not taking the bait. Lower interest rates haven't helped. And so China's in a massive slowdown. Whether it's technically a recession almost doesn't matter, because when an economy that big slows that much, it drags the world down with it. So China's not going to save us. Europe's not going to save us.
Let's recap. Today, we delved deep into the world of U.S. Treasuries with expert Jim Rickards, unraveling the complexities of the bond market. We learned about the distinctions between short-term Treasuries, medium-term notes, and long-term bonds, all within the realm of U.S. Treasuries. A surprising revelation was the current trend of the highest yields residing in 6-month to 1-year Treasury bills, a departure from the traditional yield curve. Jim highlighted the crucial relationship between interest rates and bond prices, emphasizing the need to predict interest rate movements for sound investment choices. In the face of global economic slowdowns and uncertainties, he hinted that interest rates might have peaked. As we wrap up today's discussion, remember the importance of staying informed and vigilant in the ever-changing financial landscape.